Welcome to the Organic Crop Insurance 101 webinar hosted by the Organic Agronomy Training Service. This event is being recorded and will be posted online. I am Mallory Krieger, National Program Director with OATS. OATS is a collaboratively managed training program for agricultural professionals working with organic and transitioning farmers in the United States. We seek to grow domestic organic production by strengthening the educational support network of agronomists, certified crop advisors, extension agents, and technical service providers. Our aim is for every transitional and certified organic farmer to have robust access to technical service expertise to provide unbiased, science-based organic agronomic support for their farming operation. If you would like to keep up to date with the events and happenings at OATS, I highly recommend that you join our mailing list, where we send out notifications of upcoming events and educational opportunities. I've dropped the link to join that in the chat. We have some great programs ongoing on many topics here at OATS. You can listen into our monthly Organic Advisor call series, where we interview farmers and experts, or you can join in the discussions at our Organic Advisor listserv. We are currently enrolling participants in the Organic Field Crop course, a training program for ag professionals who want to better serve organic field crop farmers. And if you could advance the slide, Megan, we can show the Organic Field Crop course information. The current class is enrolling right now. Sign up by March 20th to secure your spot in that class. In addition to today's webinar on crop insurance, OATS is also developing a podcast series exploring the ins and outs of organic crop insurance. And we are launching an online video-based course on organic crop insurance for ag advisors as well. Stay tuned, subscribe to our mailing list for announcements of when those drop. I would like to extend many thanks to the USDA Risk Management Agency for providing the funding to develop and host these crop insurance education programs for organic producers. In today's webinar, we will begin with an introduction to the Federal Crop Insurance Program by USDA RMA Organic Specialist Anna Parker, followed by a talk by Organic Crop Insurance Agent Megan Vaith on specific programs available to producers in this region. We will then be joined by Amy Brook. She is an organic producer, and she will share her experience with selecting a crop insurance program for her farm. We will also have time at the end for questions and group discussion. If you have a question during the presentation, please drop it into the chat and I will make sure that it gets answered. With that, Anna, would you tell us a bit about RMA and the Federal Crop Insurance Program?
Sure. Thanks, Mallory. Like Mallory said, my name is Anna Parker. I am a risk management specialist with the Loss Adjustment Standards branch in product management. That's a lot of letters and acronyms to describe what I do, but I basically work on the loss side of crop insurance, and I focus on organic production and also preventive planting. Risk Management Agency is a USDA agency. We're rather small, only about 400 employees nationwide, and we underwrite and regulate the federal crop insurance program. These policies, these commodity policies, protect against production losses for commodity crops from almonds to sorghum and everything in between. What we do notice is that for most point, about 70% of all losses are due to water, either having too much water or having too little water, like we've seen a lot over the last couple of years. RMA serves as a regulator and reinsurer. We work in a public-private partnership with the approved insurance providers, or AIPs. And these insurance companies are actually who the farmer has their crop insurance policy through. It's underwritten through the approved insurance provider. RMA then reinsures the approved insurance provider. Interest in crop insurance has grown significantly on the legislative side, regulatory side over the last several years and several farm bills. So we now see that the crop insurance part of the Farm Bill is the largest of the farm safety net, moving from like about 30 billion just 20 years ago to almost 200 billion today. So what are RMA's roles and responsibilities? Well, first and foremost, we develop the policy and procedures of the actual crop insurance policies. So the policy language are the actual terms, and procedures are some of the rules that that support the underwriting and loss portion of that policy. RMA also sets rates, sets the prices, and sets the T yields. All of this is done on and reviewed on an annual basis. We also support innovation and the implementation of new products. Over the last decade, as Megan will talk about, the whole farm is an RMA developed product. So now is microfarm or PRH or production revenue history coverage. Those are new products that have come through the RMA development programs. And we've also worked on expanding programs to different crops in different counties nationwide. All of what we do, the policies, the terms, the prices, the rates, the T yields, depend on actual data, historical data. So we do a lot of our own data collection. Decisions are made using our own internal data, FSA data, AMS data, NAS data. All of this data is very important when determining all of the policy terms, the prices, rates, etc. Another one of our important functions is auditing and oversight of the financial aspects of the insurance providers. So we have a branch of the agency that audits the accounts and make sure that the AIPs are implementing the policy and rules and regulations as intended. We are a primary reinsurer. Like I mentioned earlier, the farmer actually has the insurance policy or contract with the insurance provider, the approved insurance provider, the insurance company. And then RMA kind of shares in that risk by reinsuring the insurance company. And finally, RMA compensates those insurance companies for their sales and service. So they are under a standard reinsurance agreement. The insurance company is compensated for some of the expenses and some of the underwriting losses that they may have over the certain crop year from one to the next. The insurance company has a great deal of a list of roles and responsibilities as well. First is sales. So work with the farmers on a one-on-one basis to manage the policy, to help educate on what the farmers' options are, and to actually do the paperwork to issue that policy. At the end of the insurance cycle is the claims portion. And so the insurance company is responsible for adjusting or measuring that crop loss and then issuing any indemnity or a claim if necessary. They are also responsible for their own quality control to make sure the data that they are providing to RMA of the experience that they've had is accurate. They do assume some of the risk. RMA reinsures, or the USDA reinsures and shares in the risk, but the insurance company is also assuming some of the risk. Your interaction with a crop insurance, an approved insurance provider, is through your local crop insurance agent. You'll work with them one-on-one to understand the policy, to sign all of the paperwork, to you notify them in the case of a loss. They are there to support you throughout the process and to help you understand all the terms of your policy. They are the face of the program for most. They are the face of the program for most farmers that they work directly with their agents. They are. It is good to keep in mind that one crop insurance agent may write policy for more than one actual approved insurance provider, but communication is key. Next, what's your responsibility? Well, as a producer, your responsibility is to your crop and to your farm. But as far as insurance policy goes, you need to sign up or to buy the policy, to work with the agent to get the correct coverage for what you need. In the life of the insurance cycle, after the policy is purchased by the sales closing date, which is getting really close here for a majority of the north of 315, you'll provide production history. So what acres have you cropped? What crops and practices have been done on those acres? And what is your production history on those acres? Then the fun starts, where you get to plant and take care of your crop. Then midsummer, typically for a lot of crops, you'd report acreage around July 15th. Later in the summer, you'll get a premium bill. And so it's your responsibility to pay that premium. And during this whole process, if you notice a loss, you think there's going to be a loss, you see it in the field, it's your responsibility within 72 hours to let that agent know that there is a potential loss here. So it's your responsibility to provide that notice of loss. And then finally, you'll receive after the loss adjustment goes through and your guarantee is not met, then that's when a claim is insured. I did talk a lot about, working with your crop insurance agent, and they can be your best key in understanding the policy. It is still an insurance responsibility or a farmer's responsibility to understand the policy and what they are being covered for. So a little bit of history about RMA and USDA's coverage of organic. This infographic just shows the number of acres and policies over the last 10 years and how organic coverage has grown. And so we know that organic acres have consistently gone up, and that the insurance coverage of these organic acres has gone up. And this is because the coverage has changed as we learn, as we know more and learn more and have more experience with organic farmers. Then the program can change and grow to fit those needs, and we've seen the number of policies go up accordingly. And finally, just a quick snapshot of what's being insured as organic out there. As with conventional, that corn, beans, and small grains is in the top 5. I think it's the top 5 of conventional, and it is here in organic. When you look at acres and liability and premium, which is what we in the crop insurance industry usually is a strong metric. But you'll also see a lot of these human consumption crops like grapes and apples, blueberries, that sort of thing, that, consumer demand, there's more and more acres being covered under the organic practice for these crops. There is coverage for just about every crop that crop insurance covers for organic type and practices. And you'll see that we have insurance history for over 70 different crops being covered over the last 20 or so years of organic coverage with risk management agency. With that, I will hand it over to Megan. Thank you.
Thanks, Anna. And like she said, she was going through the structure of crop insurance with the RMA and the AIPs, the approved insurance provider, and the agents. I am Megan Baith, and I am I own Northbourne Organic Crop Insurance, which is a crop insurance agency specifically for organic farmers. So I fit under that agent category. I'm the one with the boots on the ground, talking to the farmers about their coverage options and making sure that they have the coverage that they want in place. And I'm going to start out by apologizing. I have a bit of a cold, so I do have a cough drop in my mouth that will hopefully keep me talking throughout this presentation. So here are a couple of the topics that we're going to cover today. First of all, how does a crop insurance policy work? Some insurance options that are specific for organic producers, some recent crop insurance changes that came about in the last couple of years, and then the transitional and organic grower assistance program. So what is a crop insurance policy and how does it work? A crop insurance policy is in place to protect a farmer against any natural peril that might happen on the operation. So like Anna talked about, this oftentimes is either too much moisture or too little, but it could also cover other events such as wind, hail, live insect infestation, or wildlife coming into your operation. Or on a revenue protection policy, it could also cover you on a revenue loss due to price changes throughout the year. Coverage options are available from 50% all the way up to 85% in 5% intervals. So this gives farmers quite a few options to choose from as to what coverage fits him best for what guarantee he needs to cover all of his input costs. Premium subsidies vary by level of coverage. So federal crop insurance is subsidized by the government. And so here on the bottom, you can see the crop insurance subsidy chart. I'd say most farmers fit into the optional units and enterprise units category. We're not going to go far in depth on here, but just to get an idea of what a subsidy looks like. So I would look at that enterprise unit column and go all the way over to 75% coverage. And there, because that's a common coverage level. And there you will see that the farmer has a 77% subsidy level. This means that the farmer is only paying 23% of the crop insurance premium for that policy. Crop insurance policies are available by crop and by county. So this gives farmers a little bit of flexibility where he can have insurance on one crop and not another, or maybe one county or not another, or he can have different coverage levels per crops and per counties, depending on what fits best for his operation. Why is it important that a farmer purchases crop insurance? We see a lot of input costs go into the operation with seed, fertilizer, whatever it may be, all these input costs in order to grow a crop. However, a disaster could happen throughout the year. And if the farmer has no crop left at harvest time, crop insurance is the only policy or input cost that is actually going to cover a sort of guarantee there and keep him farming from year to year. So it's the only input cost that can actually guarantee you some sort of revenue. The seed that you put down in the ground is not going to pay you back at the end of the year. Crop insurance is there to help pay for those input costs. So here's an example of how a crop insurance policy works. On the left, you will see a calculation for a bushel guarantee, and this is on corn. So in this example, this farmer has an approved yield of 200 bushels. That means in the most 10 recent years of farming history, this farmer had an average yield of 200 bushels because we go on a 10-year average. Then this farmer selected a coverage level of 80%, which is fairly common, to get a bushel guarantee of 160 bushels. This means at harvest time, if the farmer is harvesting and maybe she has less than 160 bushels per acre at harvest time when she's combining, she can call her agent and file a claim because she will trigger a loss as long as she's under 160. On the right, you can see how we calculate the revenue guarantee side of things. We take that original bushel guarantee of 160 bushel, multiply it by the spring crop insurance price, which was $11.72 in 2022. So this is last year's numbers, to get a guaranteed revenue of $1,875. So this means if this farmer had a complete disaster and there was no crop left in the field at harvest time, she would collect $1,875 per acre on this operation. So a crop insurance guarantee can actually change throughout the year depending on where the harvest price comes in at. And the crop insurance prices are tracked twice a year, once in February and once in October. And we'll go into that a little bit more later, but this is an example of how a harvest price either going up or down could change a crop insurance policy. So on the left here, we see what happens if the harvest price is actually higher than the spring price. So we take the original bushel guarantee of 160 bushel, multiply it by the harvest price, which here I used $12.80 instead of the $11.72, to get a new guaranteed revenue of $2,048. On the right, you can see what happens if we have a lower harvest price. So to calculate that, you take your original guaranteed revenue and then divide it by the harvest price, the new price. So that would be $10.75 in this example, to come up with a new bushel guarantee of 174 bushels. So in this situation, instead of having to fall below 160 bushels to trigger a loss, the farmer only has to fall below 174 to trigger a claim. This calculation might seem kind of goofy, and it's an odd way to calculate it, but realistically, when the price drops, it now takes more bushels to get to that established guarantee than it would have if the price had remained at $11.72. So the examples we just went over were on revenue protection, which is kind of the most common and most premier crop insurance policy out there. So can I get revenue protection on all of my crops? I'd say corn and soybeans are available in most areas where the crop is actually farmed. And then when you get into more specialized crops, it actually goes on a county by county basis. So here's a map showing the coverage availability options for corn. As you can see here, the majority of the US is covered in green areas. And the green areas show that coverage is readily available, which means a farmer can go to a crop insurance agent and get crop insurance coverage on his corn acres, even for the very first year of farming. It's just readily available for him. Here you can see in soybeans, it doesn't cover as much of the United States, but it still covers most of the counties where soybeans are actually raised. And then you can see oats as we get into a little bit more specialized crop that it doesn't cover the same region, it's a different region, but still very well covered throughout the US. Then we get to sunflowers, where a lot of organic farmers are starting to incorporate sunflowers into their rotation. And we can see that there's only a strip down the middle of the United States where sunflower crop insurance is readily available. So this does not mean that if you're in a white area, you cannot get crop insurance. There are options for these farmers that fit in those white counties on those maps. So some of the main two options that these farmers can pursue is a written agreement or whole farm revenue protection. A written agreement is basically a packet of information that the agent and the farmer work together on in order to submit to the crop insurance company requesting crop insurance coverage on those acres if the crop isn't insurable in that county. This is due by sales closing, which is September 30th for most fall planted crops, and then March 15th for most spring planted crops. So we are coming right around the corner on March 15th, which is the sales closing timeline for spring crops. The agents will work with the farmers to prepare this packet and submit it to the crop insurance company to try to get insurance on those acres. This does require supporting documents, which I'll go over on the next slide. And in my opinion, this is really necessary in order to expand the crop insurance program in the future. So when RMA is looking at expanding maybe sunflower coverage, like we had just gone over on that map, to make more of those areas green rather than white, one of the resources they're going to look at to see if they should expand the crop insurance coverage is if they have written agreements for that county. And if no written agreements were submitted for that county, it does kind of show that there's really not a need for crop insurance in the county because nobody's requesting it. There are other resources that RMA uses to expand the crop insurance program, but I know this is an internal process that they use pretty heavily as they look at expanding the program. Here are some of the requirements for a written agreement to be submitted. So the farmer and agent work together to submit the dates that the crop is normally planted, the name, location, and approximate distance to the place of delivery. If the crop is irrigated, you need to list the main water source and the method of irrigation. And then there is a crop history requirement, which is usually what makes a lot of farmers pause. And so a farmer must verify that they have at least 3 years of history on either the crop that you're requesting or a similar crop. And this isn't just what a farmer might think is a similar crop. It is based on a list of approved similar crops within the written agreement handbook. And I'll go over some examples on the next slide. If a farmer is just starting out and he is part of an entity, so he doesn't have any crop history to prove in order to qualify for the written agreement, As long as someone in the operation has at least 10% ownership, has history of either the crop you're requesting or a similar crop, he can use that history in order to qualify for crop insurance coverage through the written agreement process. Then we need to submit soil maps and a letter of adaptability from an ag expert, which is typically from an agronomist or a conservation professional, just saying that sunflowers in this example can be grown in this area. So here's a list of similar crops for canola. And one thing to take note here is even though you need 3 years of history in order to qualify for the written agreement, your 3 years of history do not have to be for the same crop. So if someone was trying to get crop insurance coverage for canola and he had 1 year of history of barley and 2 years of history of oats, that would qualify for his 3 years of history in order to obtain coverage for canola. Here shows the approved similar crops for sunflowers, and these can be used intermittently. So if a farmer was wanting to request coverage for dry beans instead, you could just replace dry beans with sunflowers on this list to qualify for similar crops. So if he had 3 years of history of sunflowers and he wanted dry beans coverage, that would cover him in order to apply for the written agreement. Like I said, there were 2 options in order to get coverage on those crops where crop insurance wasn't readily available. Whole farm revenue protection was the second option there. And this is kind of a whole different way of looking at what crop insurance is for a farmer's operation. So instead of looking at the yield per se for each crop, this takes an overall revenue of the entire operation. So to calculate your guarantee, you take your most previous 5 years Schedule F, which is farm tax history, and average those numbers together for what your allowable revenue was off of your last 5 tax returns. Then you compare it with what your expected revenue is going to be for the coming year. You take the lower of those 2 numbers and multiply it by your coverage level in order to calculate your guaranteed revenue. The biggest kicker with this is in order to insure under whole farm revenue protection, since it is based on Schedule F tax history, the farmer has to have 5 consecutive years of farm tax history unless he is a beginning farmer, which means that he gets an exception and only needs 3 years of history in order to qualify for this policy. Coverage options are available from 50% to 75% unless the farmer has 3 or more commodities. And if he does, then he can purchase 80 and 85% as well, and he'll also be eligible for the whole farm premium subsidy. Like I mentioned, this is great because it could cover a lot of crops that maybe crop insurance isn't readily available on. And a good way to get crop insurance coverage even in the first year that you're farming a crop, which you can't submit a written agreement on because you don't have the 3 years of history. So it covers pretty much every crop, including livestock, except timber, and then livestock for show, sports, or pets. Otherwise, if you have like a turkey barn, or maybe you're a very diverse farmer that has a lot of fruits and vegetables on your operation, this could be a good way to make sure that you have insurance on those commodities. Some of the biggest downsides to whole farm revenue protection is that there is lots of paperwork involved. So since it is based on Schedule F history, in order to even calculate a quote to see what coverage looks like for a farmer, you need to submit those 5 years of tax returns to your agent to see what coverage can look like. And then there's more paperwork throughout the year as well. I will say that RMA has done a really great job trying to eliminate some of the paperwork reporting process on this policy, which is really great, but I just want to make note that there is more paperwork on this than a standard revenue protection policy. However, I do not think that it's a reason to shy away from the policy because this could be really beneficial to some farmers. The other thing to take note on for whole farm revenue protection is that claims will be more delayed under this policy than your standard revenue protection. So when you're talking standard crop insurance, a farmer goes and harvests his yield in the fall, and if he triggers a loss, he calls his agent, an adjuster comes out and they finish up the claim and he gets paid in a fairly timely manner, typically still in the fall. This policy, since it's all based on Schedule F revenue, you will not actually trigger your claim until your taxes are filed for that year. So instead of getting paid out in the fall, you now won't get paid out on a claim until the following spring or summer. Contract pricing is a really great benefit that is available for organic producers. And this allows organic farmers to insure their crops at their contracted price. Without contracts in place, you have to use the RMA established price, which is the daily closing Board of Trade price throughout the entire month of February. They look at the daily closing price for every day in the month of February, average it together, and that is the RMA established price on conventional crops, because as we are all aware, they're not trading organic crops on the Board of Trade. So then they take that conventional price and they take it by a factor to allow for an increase in value on organic crops. So for 2023, those were taken by a factor of 1.878 on corn and 2.056 on soybeans to come up with what the RMA crop insurance price is for organic commodities. In order to use contract pricing instead, which allows you to substitute that RMA established price for what you individually contracted your grain for, you have to have this special option on your policy by sales closing, which is oftentimes March 15th. So like I said, right around the corner here. Then in order to also use it, you need to submit a copy of your contract to your insurance agent by the acreage reporting deadline, which is oftentimes July 15th. One thing that I like to tell farmers is that this is a really great option to just have on your policy in place in case you want to use it. So what I suggest is having it on your policy by March 15th, and then come summertime, if either you don't have a contract or maybe your contract is lower than what the crop insurance price is, you just don't submit it to your agent and you won't have to use it, and then you don't have to actually pay any extra premium by just having that option on your policy. Contract prices are capped at 1.5 times the organic crop insurance price on corn and 1.75 times the organic crop insurance price on soybeans. I will say that I've never seen a contract go above and beyond these caps. So I just want to make sure that everybody is aware that they're out there, but it really hasn't been an issue up until this point. So here's an example of how contract pricing could benefit an organic farmer as they're looking at what their guarantee would be for the year. So this farmer had a bushel guarantee of 48 bushels on soybeans. And last year, the crop insurance price was $27.41. So this gave him a guaranteed revenue of $1,315. However, this farmer was able to get a contract for $38 a bushel on his soybeans last year, which I have seen happen. So instead of using that $27.41, he was able to substitute it for the $38 and actually get an extra $500 in guaranteed revenue for the year. Now, we dealt with a lot of extreme drought in this area this past year. And so I think it's just something to keep note on, that you could, I witnessed farmers that got paid out more on their crop insurance claims because of having contract pricing in place versus how it would have been under the RMA established price. Pasture rangeland forage is a kind of a new look on crop insurance as well, where it insures any perennial haying or grazing acres based on lack of rainfall in the area. This policy is index driven, which means that they looked at the NOAA weather data for each area all the way back to 1948 and came up with the average rainfall from now to 1948. So that average rainfall is an index of 1.0. And then the highest coverage level you can have on this policy is 90%. So anytime the rainfall for a time period that you select is less than 90% of average, you trigger a claim. So this policy covers a grid area rather than your individual farm. So a lot of times it's about a 17 by 17 mile radius. So the rainfall numbers might not reflect your actual farm's rainfall, but they still will be relative to the area. In order to choose insurance under this structure, you have to select at least 2 different intervals of 2 months each. So a lot of times when farmers are looking at this policy, they're thinking that they have the cows out on pasture in the summer, so they want to make sure that they insure May, June, and July, August for the months that their cows are out on pasture. However, you actually can insure more intervals if you want. So if you want to have insurance over the entire year and have 6 different intervals in place, you have the option to do that. One of the main reasons I really like this policy is that it allows for more flexibility than other crop insurance policies. So for corn, for example, if you plant corn, every acre you plant to corn if you have corn on your policy, then every acre you plant to corn in the county automatically has to be insured. Here, you select the fields up front that you want to insure. So you can pick and choose which ones you want to insure rather than having it be a all or nothing type of deal. One other main reason I like this is that the producer doesn't actually have to report any yield or rainfall history. It is all tracked on the NOAA weather stations, and then whenever it falls short, a claim is automatically triggered with the crop insurance company. So a farmer doesn't have to call his agent and say, I don't think I got any rain this time period, or whatever it may be. Where typical forage policies, you have to list like how many bales you had per cutting and the weights per bales. Here, you don't have to report any of that. It is strictly on rainfall. Sales closing for this policy is December 1st. So at this point, it'd be something to look at for 2024. And here's an example of how it could work. So I am from South Dakota, and this is actually the example from my land personally. And so here I ran a 10-year summary as to how this policy could be structured for a farmer in my area. And this is how mine is structured. And so you have to pick different percentages of acres per time period. So what I did is I did 40% of my acres in January and February, 35% in March, April, and 25% in June, July. And you can see on the left here, I ran a 10-year history. So then that second column in shows the indemnity. So how much payment was triggered for the entire year for each year. And then you'll see the premium, and my premium on this is roughly about $7 an acre. And I should add that this is on the grazing land. If a farmer is wanting to insure haying land under the same structure, it has a lot higher value, so the premium can be higher, but there's different coverage levels that you can select to try to make that premium more in a reasonable price range. Then that last column, you can see the profit or loss summary as to how it does throughout the year. And so I think this is a really attractive policy for farmers in order to kind of cover some of the loss that they're having when their pastures or hayland does not receive moistures, where they have a lack of feed on their operation and maybe they have to go out and buy feed. This could help cover some of those costs. Livestock risk protection insures cattle or swine solely on a decline in price. So death loss is not accounted for under this policy. There are different endorsement periods that a farmer can select, which is between 13 and 52 weeks. And the farmer should choose the time period closest to when either he's going to sell the livestock, or they reach the desired weight, or they're going to reach the weight class maximum, because there are different weight classes that you have to choose. Livestock risk protection is subsidized. And so that chart on the top right shows the premium for livestock risk protection over 6 years. So from 2016 to 2021. And you can see that 2016 to 2020 sales were pretty steady and pretty minimal. Then in 2021, it kind of skyrocketed. And I'd say it stayed that high since then too. And this is because RMA changed the subsidy factor. So they increased the subsidy by another 20%. So on the bottom there, you can see the subsidy factors. And this policy is really cool because you can virtually get all the way up to 100% coverage under livestock risk protection, where in a typical crop insurance policy, there is quite a bit more of a deductible in place. Indemnity is triggered on LRP if the actual ending value is less than the coverage price. And here's an example of how this would work. And this is a 13-week time period on steers in the weight 2 category. And so this means steers that are between 600 and 900 pounds. So in the middle there, you can see the headline is expected ending value. It is showing that, and I ran these numbers last night, it is showing that at the end of the 13-week time period on June 8th of 2023, they're expecting the value of steers in the weight 2 category to be $208.94 per hundredweight. So this top line shows a coverage of 99.74% coverage. And so the price, the guarantee, is going to be $208.39 per hundredweight. So this is meaning that on June 8, 2023, if the price is lower than $208.39 per hundredweight, you trigger a loss. So it doesn't really matter what you specifically sell your livestock for. It is all tracked either through the board or local prices. Relay cropping was announced for the first time in 2022, where farmers were eligible to insure their relay cropped soybean acres under federal crop insurance. And there are some requirements in place on this depending on the region. So this is on a case-by-case basis with written agreements. A farmer will need evidence of practice viability in the region, and this is the same as that letter of adaptability we talked about before. This is typically from a certified agronomist or conservation professional. Some regions require anywhere from 0 to 3 years of history. And so as you can see here, this is showing the map of what kind of requirements are necessary. So that zone 1 shows that no records are required, meaning that you can submit the written agreement and get coverage on your relay crop soybean acres without having to have 3 years of history. However, in that blue area, there is a requirement that you need 3 years of history in order to qualify for the written agreement to get crop insurance coverage on those acres. Double cropping crop insurance coverage availability was expanded in 2023 for both soybeans and grain sorghum, and this allows farmers to raise 2 crops in 1 year. So I think most of us will fall under that double cropping soybeans map in that yellow area, and that is showing that you can qualify for double cropping coverage if you submit a written agreement. However, you have to have the 3 years of double cropping history in order to qualify for this. TOGA, or Transitional and Organic Grower Assistance Program, is available in 2023 for transitioning and organic farmers. And this allows these farmers to get extra premium assistance on their crop insurance premium. And so transitional organic crops receive an additional 10 percentage points of subsidy. Then certified organic crops receive an additional $5 per acre premium discount. And then whole farm revenue protection policies also receive an additional 10 percentage points of subsidy. The list here on the bottom of all the crops show what crops are eligible for this TOGA program, which is pretty much every crop. So it's really something to take note of as you are making your crop insurance coverage elections for the year. And so when a farmer is looking at quotes that an agent ran off for him to decide what coverage level he wants for 2023, those quotes will not reflect these premium discounts. These premium discounts are just going to come and play on the billing statement later in the year. So it's something to keep in mind that if you're a certified organic farmer and you're looking at your crop insurance coverage quote, your premium is actually going to be about $5 per acre cheaper than what the quote shows. And that was all I had. So I can hand it over to Amy, where she is going to tell us a little bit about her operation and how she uses crop insurance on her farm.
Certainly, Megan. Thank you so much for your presentation. This was very informative. And Mallory, thanks for hosting this session with Oats. This is a really important topic and something I'm very passionate about. And Anna, thank you also for providing the RMA perspective as well. So my name is Amy Brook. I'm a 6th generation farmer. My family farms are in East Central Nebraska. I've had a really interesting, career path. Went to school at Iowa State, got an ag engineering degree. So I love everything about science and farming and math on top of it. So a lot of spreadsheets go into our family planning for our farm. I've spent some time overseas. I lived in Brazil with my husband for over 6 years. So I got to see farming firsthand on a production level in a developing nation. And we were very rural. So it's a very interesting process to really have, and I feel very blessed to have that. And then my husband and I, we also did some various consulting projects across several different countries and continents, in Africa, all across South America, Europe, etc. So it's been a real pleasure for me to really understand understand firsthand production of farming, something that I know and love in various geographic areas. Life brought me back to my family farm. My father unfortunately passed away. And so instead of farming for him, I'm farming, or instead of farming with him, I'm farming for him. And most recently, in the last half decade on our farms, we've been converting to organic production. So I have experience in conventional production in Nebraska, as well as organic and transition. I'm a firm believer, just because of my international experience, to leverage our resources. We're a developed nation, so having the opportunity to apply crop insurance to our farm to help us mitigate risk with all those variables that we can't control as farmers, it's really really, really important. Because in Brazil, I call it farming without a safety net. You could have a home run one year and you could have a strikeout, and a strikeout doesn't bring you back to zero. You're going way backwards to the point that you might not be able to even try farming the next year. So again, I said my background is 6th generation farmer. I have a son, so hoping to keep the family farms going into the 7th generation. So being able to do that is deploying crop insurance. Also, my background in engineering makes me a firm believer in continuous improvement. It was awesome to see all the improvements that RMA is making. So that summary sheet, Megan, was super helpful. I know we're moving in the right direction, and I appreciate Anna's participation here. But yeah, I've been able to see crop insurance function and see some opportunities on my farm. We talked quite a bit about multi-peril insurance in this discussion. That's really important. It was an interesting statistic that 90% of the farmers are experiencing floods and droughts. One of our main perils in Nebraska is actually hail and wind. So that's something that I've had a lot of experience with. I couple both a multi-peril type policy that Megan was referring to, in addition to several options within the private insurance category for hail and wind. And one thing with organic producers, some of us have run into this. I think a majority of us have run into this, where when we, if we have a conventional farming history and we move into transition, you're actually, since you don't have any transition production history, you're given a new set of T yields because you don't have your own actual production history. So in many cases, and that's a challenge, us organic farmers farm very differently, because our priorities on our farms are different. They're not always driven by bushels. We're looking at robust crop rotations and other things that matter to us. So it's really tough to get the right actuarial information for each organic producer just because of our diversity. In my case, and I'd say this happens to a lot of organic producers, when you hit transition, your transition T yields, or in my case anyway, did not match my actual capacity, my actual output of production. So I had a wide delta between what I was actually doing production wise as a producer and what I could cover. So essentially, just to put it in layman's terms, it's like buying a house. If your house that you're buying is, let's say it's $150,000 and it's appraised for $150,000, and you're told, hey, you only have insurance coverage for $50,000 of that delta of what your house is worth, $150,000 versus what your coverage is basically self-insuring. You're self-insuring that delta in any problematic event. And that's what I've run into on my family farms, that big gap in coverage from what my farm revenue is based on my capacity of production and the coverage level that I'm able to get. So that's a big passion point of mine. There's so many challenges in organic farming anyway. And unfortunately, we all know very well if you're in this type of farming. And so being able to count on things like insurance to bring us back to whole is really important. And I did mention some other things and strategies that I do deploy, since the perils on my farm are unique outside of some of the wind, some of the drought and rain. I'm able to apply additional products of coverage to fill some of that gap that I'm experiencing. And those come into play. You can either go 2 routes when you're looking at hail. One is on your production. But again, if your production levels are different than your T yields that you're given on the early onset, then you're not necessarily going to tap into any coverage yet again, unless you go below the trigger level of that T yield. So a different product that's available is actually just a damage-based type product, where they're assessing the damage in your fields, and then you're getting a payout based on damage. And those, there's a variety of different, we learned about the approved insurance providers, AIPs out there that offer these hail and wind policies. I really strongly encourage producers to evaluate many options, challenge your agent to be able to tap into many of these different companies. A one-stop shop it is not always the best. There are differences in these policies when you're getting into the unsubsidized policies that are offered, and you really need to know what your options are. Press your agent also to see if you can get additional coverage. Sometimes with organic production, like I said, there's some gaps, but if you're willing to ask the question and show your potential revenue capacity, or that you have a contract that can show your revenue capacity of what you're anticipating, you might be able to increase the max limits for coverage there. So I really encourage that. Let's see, another thing to really consider is just looking at farming within the crops that you're really able to get insurance on. I mean, I would love to add more diversity on my farm. It's tough. Like I said, we want to keep our farms going to the next generation. So it's interesting to hear. It's kind of like the chicken and the egg kind of situation. You know, we have to prove that we can do this for 3 years almost at times before we're able to get some level of coverage. And I understand that completely, but as a farmer, as a younger farmer, probably not young, but middle-aged farmer with a few more seasons left me, I want to learn so much more. I know that I can produce these crops. I know they're set for my region. So I would love the opportunity to expand the diversity of the crops on my farm. But again, I want to keep this farm going to the next generation. So it's tough. I'm not going to be able to, unfortunately, show a lot of crop diversity to get this additional coverage. Those maps were really interesting to me to see that some of the decisions are based on, you know, how many farmers are requesting these crops. I've gone through the written agreement process, and again, when I go through that, I've had some experience with just getting really depressed T yield coverage results. And so I choose not to necessarily grow that crop. So anyway, I try to be very disciplined, again, just because I have seen farming in developing countries that don't have the ability to get insurance at all. And I know firsthand what happens. So I'm just a real proponent of trying to mitigate risks as best as we can, and just really get educated on the products that are out there. They do seem to function, unfortunately, a little bit different than the conventional counterparts. I'm going to leave it at that for now. I don't necessarily have a PowerPoint to keep me on track, but I got a lot of examples of firsthand experience using these on my fields, but I'm just going to stop there and then see if we have any questions, I guess.
Awesome. Thanks so much, Amy. Great overview of crop insurance programs from all three of you and personal experiences. Are there any questions that anybody would like to raise to any of our three speakers? We've got a handful of minutes available to make sure that your questions get answered. We don't have any in the chat right now. So if you have a question, feel free to unmute and just ask it directly. Well, I've got a couple of questions. You go ahead, Megan. I've got a couple of questions that I can ask. Yeah.
Perfect. I was just going to say thank you, Amy, for the wonderful overview and impressive resume of your operation. I thought that was really great that you included the hail insurance side of it. And one thing that, well, we didn't really talk about hail insurance, but hail insurance has different limits of liability per crop. And so you can only insure up to a certain dollar amount. And so like she was talking about, sometimes you can use a contract that you have in place in order to increase the limits of liability. And each approved insurance provider will have different limits on each crop. And so shop around and see which one works best for you. And with that, since it is a private unsubsidized product, each crop insurance approved insurance provider is also going to have different rates on there as well. So it's something that you kind of shop around and see what fits best for your operation. So thank you for bringing that up. I thought that was a really great aspect to add to it.
Yeah, absolutely, Megan. No problem. And actually, you reminded me of one more thing, and this was a learning lesson that I had last year. The contract price addendum, which Anna and yourself talked about, it's a great option, and I highly recommend looking at that, or at least having your agent add that to your policy if you're still working on contract negotiation, which I am right now. And then you can deploy it, like Megan said, by July 15th in the Midwest states here. But one thing I learned last year, contract price addendum is great, but sometimes our contracts are actually show a picked up price on our farm instead of a delivered price to, let's say I'm in Nebraska, I'm delivering grain to Illinois, but my purchaser over there said, hey, I'm going to factor in on your contract the transportation costs. So it appears that my price is lower than maybe what it even is, because it's the net price, not a gross price. So I highly recommend farmers to actually make sure they're getting a contract price, that it's a delivered price, not a picked up price, because that could give you, from Nebraska to Illinois, with the gas prices that we're going on, it could be a $1 bushel difference or even more. So I really make sure you get the gross price and not the net.
All right, well, the question that I have, which any of you could take up, is Oats works, as I mentioned at the top of our call, Oats is working primarily with ag professionals, those who are working in an advisory capacity with organic and transitioning farmers. And so I'm always looking for advice that I can give them, or things that ag professionals would need to know to make sure that they're working well with organic farmers and not putting organic farmers insurance eligibility at risk. So are there any common practices that we see in organics that can be that can cause issues for organic farmer insurability, that an ag professional who's advising on agronomic practices should really be aware of, things that they need to know, that if they tell a farmer to do that or try it, could put their crop insurance eligibility at risk?
I would say yes, there are definitely some, and a lot of it falls under like interseeding. So like I have a farmer that I'm working with right now that wants to plant his corn into dry peas, and he cannot do that. You can't plant corn into a legume, and so that is not allowed. So there's kind of a whole list of restrictions as you read through the handbooks. But it's always good to just have that conversation up front and see where you're at. And I think most insurance agents would appreciate a phone call from the ag advisor as well, just to make sure that everything is out in the open before they go around and tell farmers to do this. And then they have to course correct later on throughout the year. I don't know, Anna, you unmuted. I don't know if you have anything you wanted to say there.
Not much to add. I'd say the policy word for interseeding is interplanted. That's the actual word you'd see in the basic provisions. And so a lot of those are not insurable. I work out of Kansas City, but I'm physically located in north central Montana. And up here, a lot of organic producers and even conventional producers like to use a nurse crop. And that practice, unfortunately, is not insurable. We have seen expansion. Some believe that relay planting is a form of interplanting. Technically, for policy language, we separate the two because they can, they're not grown necessarily at the same time. And the issue is being able to harvest and measure production separately. But we have seen an expansion, like you mentioned, in relay planting. And so and that was, part of working with organizations and farmers across the country to understand what people are doing and what land and operations are capable of. I would say that the another thing that ag experts need to be aware of is to kind of piggyback on what Amy said, is what crops are actually insurable in the area. I've seen a lot of really, for lack of a better word, cool rotation plans. But some of those crops are not insurable. The multi-peril is a federal program. And it is crop insurance is a risk mitigation tool. It is not great. If there are certain experiments that you're undergoing on your farm, crop insurance might not be the best tool for that practice. But as practices and crops become more common and we get more data, then we can see program expansion and program changes. And that's what we really like to see.
Mhm. Yeah, that's a good point. Mallory, I just have one thing to add with that, and something for ag experts to really be engaged in the process when an organic farmer has a weather event that happens on their farm. Generally an adjuster really likes to have everything sit as is for essentially 10 days. And we all know what happens on an organic farm when we let our fields sit when we're in the heart of weed management. So we really need to have those open conversations with your agent, with your adjuster, and it does help if an ag expert is involved with the farmer to convey the importance of caretaking through weed management. And we know how sometimes violent our weed management practices are, but we just need to have that whole spectrum, whole scope of what we do during weed management, even on injured plants, conveyed accurately, because sitting and waiting for 10 days while the crop recovers will then lead to another disaster on our farm. So being engaged in the entire process is really important.
Great. Well, with that, we are at time. So thank you all so much for joining us today.